Good morning, Neil. What do you make of the CPI data today?
Well, the CPI number was a tad worse than expectations. There continues to be this sort of nagging shelter issue. So the shelter number was a little bit firmer than expectations. That was driven to a large extent by lodging, so hotels. But core CPI came in a tenth firmer than expectations, coming in at 0.3%. And, we have the PPI number coming out tomorrow, and I'm curious to see what that does. There was some, I guess you could say, overstated issues, I think, or components within the CPI, primarily airfares. I mean, airfares rose, I believe, about 4% over the month, which seems a little bit surprising given the decline in oil prices, and also, the fact that anecdotally we know that airlines have been slashing fares given excess capacity. So I do think that's a little bit surprising. So I'm curious to see how that looks in the PPI number tomorrow, because we know that certain components of inflation in CPI don't actually directly feed into the preferred PCE measure, and airfares are one of them. So, my sense right now is that if I take the components of CPI and kind of make a rough estimate of core PCE, I think it'll probably round up to 0.2%. So I don't think PCE will look as bad as CPI, but we'll see more on that tomorrow.
And where does that fall then for your call on 50 next week?
Well, I mean, at this point, I've been doing this long enough, Adam. I'm not going to let the let one data point sway my opinion. I still think the overall story is the same, which is if they go 50, it means that Powell wants to go 50. Now, obviously, the inflation data this morning makes it a little bit more of an uphill climb, and it probably cements 25 basis points. But make no mistake, if the Fed goes 25 basis points, the odds are that they'll have to go more later. So just because they don't start with 50 doesn't mean they won't be going 50. I still think 125 basis points of rate cuts is a reasonable baseline expectation for this year. So if they go 25 in September, it means they'll be going 50 and 50 in November and December. I do think the risk with 25 is that it'll put more weight on the dots plot, because it sort of shows that there's a lot of consensus building, a lot of hand-holding that's going on. Powell doesn't have the votes for 50, in other words. But that increases the importance of the dot plot. And when you think about the dot plot, the last time we saw it was in June. They had just one cut in that projection. It's very hard for them to go from one to what the markets are pricing in one meeting, in one quarter, right? I mean, in one projection. So that tells me that you're sort of setting yourself up for some disappointment here. And I think the risk with 25 and maybe a dots that show, let's say, 3 cuts, is that you're going to sort of fuel these bets that you're kind of going a little bit behind the curve here. And, dragging out a bunch of 25s is a huge risk. So given how far I think the Fed is from neutral. So to me, by not going 50, they'll put more weight as a result on the dots plot, and that dots plot will probably not be easy enough to ratify the market's expectations, which means that Powell's going to have to come out and make, some kind of cleanup on aisle 6 sort of thing at the press conference by basically, laying the foundation for jumbo moves at later meetings.
And there's nothing between now and then, like retail sales, that would change this at that point?
Look, I mean, I think the economy's in a very fragile spot, right? I don't know that retail sales will sway them, but my assumption is that it's not going to be a particularly good number. I mean, auto sales were pretty weak over the month. We know that the numbers reported nominally, and we know that gasoline prices are down, so the headline number won't look particularly good, and you're going to get an unwind of the Prime Day effect, right? So to the extent that Prime Day was juicing the numbers up in July, that's probably going to reverse to some extent in August. And then you think about the fundamentals, like what's the upside for consumer spending? We know the savings rate's been getting drawn down. We know that private sector incomes have been slowing. So the ammunition for stronger consumer spending just isn't there. So as I say, I mean, the rationale to go 50 in my mind is pretty clear. The question is whether Powell just wants to rip the Band-Aid off and do it, or does he want to take more of a stair-step type approach? And I think the risk with the stair-step type approach is the same risk that they ran in July by not cutting in the first place. You'll just, get a bout of weak data, and that'll fuel bets that the Fed's behind.
Thanks, Neil. We'll be watching those dot plots.
All right, thanks, Adam.